Hello everyone. Welcome to this presentation on Business Responsibility and Sustainability Reporting, commonly known as the BRSR framework. My name is NVS Pawan. I am a chartered accountant and a GRI-certified sustainability professional. This presentation is a part of the deep dive series into the BRSR framework. In my previous videos, we had an overview of the BRSR framework. We had discussed section A and section B of the framework in details. In this video, we will look at the disclosures under BRSR Core. BRSR Core is a subset of the BRSR framework, which consists of 9 metrics. I chose to talk about BRSR Core before discussing the disclosures under each of the NGRBC principle of section C of the framework. The reason being, BRSR Core consists of the 9 most critical ESG performance metrics. BRSR Core KPIs are subject to reasonable assurance for the top listed companies. These top listed companies also need to report on the same BRSR Core metrics for their value chain partners from financial year 25-26. So let's get started. Having understood the importance of BRSR Core, let us have a look at its structure. BRSR Core has 9 KPIs which are divided into 29 data points. These KPIs cater to the performance of the entity with respect to environment, social, and governance aspects. With respect to environment, the entity has to disclose about its greenhouse gas footprint, water footprint, energy footprint, and waste management practices. They are all related to Principle 6 of the NGRBC. The disclosures regarding the social obligations include employee well-being and safety, gender diversity in business, inclusive development, and fairness in engagement with customers and suppliers. They relate to principles 3, 5, 8, and 9 of the NGRBC. The disclosures regarding governance is about openness of the business and relates to principle 1 of the NGRBC. We will discuss all these 9 KPIs and the 29 data points in details in the subsequent slides. Let us first discuss about the first KPI, which is the greenhouse gas footprint. Here the entities need to disclose their scope 1 emissions, scope 2 emissions, and their greenhouse gas emission intensity. Now, understanding these terminologies will require some background knowledge. So let us first gain the background knowledge and then we'll discuss about these. Let us first know about the greenhouse gases and the concept of measurement or calculation of the emissions using the GHG Protocol corporate standard. There are 7 greenhouse gases: carbon dioxide, methane, nitrous oxide, hexafluorocarbons, perfluorocarbons, sulfur hexafluoride, nitrogen trifluoride. Carbon dioxide is the most common greenhouse gas. What do these greenhouse gases do? They form a shell in the atmosphere over the Earth's surface and trap the heat energy, whatever is radiated from the surface of the Earth, into the space. By doing so, they start to increase the temperature of the Earth's surface, which is commonly known as global warming. All these greenhouse gases are measured in tons of carbon dioxide equivalent because carbon dioxide is the most common greenhouse gas. And all these greenhouse gases also have global warming potentials. For example, the global warming potential of methane is 28, which means that 1 ton of methane has a potential to warm the surface of the Earth 28 times than 1 ton of carbon dioxide. Now, all entities emit greenhouse gases in their operations. The measurement or calculation or estimation of these greenhouse gas emissions is done using GHG Protocol corporate standard. This is a gold standard which is adopted by most organizations all over the world to calculate their greenhouse gas footprint. As per the standard, there are 3 broad categories of emissions for every entity. Scope 1, Scope 2, and Scope 3. They are called the operational boundaries of the emissions. Any entity will have greenhouse gas emissions directly because of its operations. These can be stationary emissions because of furnaces or boilers in the plant, etc. Could be mobile emissions because of the trucks and other transport vehicles owned by the entity. Certain industries have greenhouse gas emissions in their manufacturing process itself, and there could be some fugitive emissions from miscellaneous sources like pipe leakages, etc. As per the standard, every entity needs to have an organizational boundary based on either of the two approaches, which is financial control or operational control. Once the organizational boundary has been set, the entities identify the sources of emissions within the boundary. All the emissions from those sources within the boundary are direct emissions and come under scope 1. Next, every entity requires electricity to run its operations. This electricity is sourced from a power grid. The consumption of electricity by the entity is directly leading to the consumption of coal or natural gas somewhere where the power is generated. So the consumption of electricity is directly proportional to the burning of the fossil fuel by the power generation facility. So there is an indirect emission by the entity by consumption of electricity. This indirect emission by consumption of electricity comes under scope 2 as per the standard. Now, coming to scope 3, no entity can operate in isolation. It will have an upstream value chain and a downstream value chain. And both upstream and downstream value chain will have activities which generate GHG emissions. Some of the examples could be purchase of goods and services by the entity. So the suppliers of goods and services will have emissions in their facilities. Similarly, purchase of capital goods. The suppliers of capital goods or assets will have emissions in their facilities. Because during the transmission of electricity will have certain greenhouse gas emissions. The transport operations, the trucks or the ships or the airplanes bringing in material will have certain emissions. The commuting of employees from their homes to their workplace will have some emissions. Similarly, the employees of the company traveling on business purposes also are associated with some emissions. Upstream leased assets will have some emissions. Similarly, downstream transport and distribution, processing of sold goods before they are consumed by the actual consumer, usage of the sold goods, recycling of the sold goods, disposal of the sold goods, downstream leased assets, and franchisees. All of these are upstream and downstream value chain activities which have greenhouse gas emissions associated with them. All these activities will come under scope 3 as per the standard. So here we get clarity about scope 1 emissions, scope 2 emissions, and scope 3 emissions of the entity. Another concept which we need to know before we get into the disclosures under greenhouse gas footprint is the concept of purchasing power parity. Now, all of us know about the concept of exchange rate, which is, for example, $1 is equal to 83.68. Now, what does this mean? This means if we want to buy $1, we need to give 83.68 rupees. But what does this not mean? This does not mean that any commodity which is sold in the United States for $1 would cost 83 rupees in India. What needs to be taken care here is that the general cost and standard of living in India is not accounted for in this exchange rate. This is taken care by using the exchange rate which is adjusted by purchasing power parity or PPP. PPP is the exchange rate at which one nation's currency would be converted into another to purchase the same commodity and the same amount. As we said, it is based on the general cost and standards of living of the country. The exchange rate after adjustment of purchasing power parity between dollar and rupee is only 22.88 rupees. It may be noted here that the exchange rate fluctuates and is published on a real-time basis. The PPP-adjusted exchange rate is released on a yearly basis by international organizations like OECD. Having understood the meaning of Scope 1 and Scope 2, let us understand how do organizations disclose their greenhouse gas footprint. To understand this, we will take the example of steel manufacturing sector, Tata Steel. Tata Steel emissions run into million tons of carbon dioxide equivalent. The Scope 1 emissions of Tata Steel are extremely high. It's almost 8 times the Scope 2 of Tata Steel. That is the indirect emissions from electricity consumption. Now, these emissions in Scope 1 would be due to the mining operations and the thousands of trucks operating in the factories and in the mines. Coming to the intensity, Tata Steel has expressed its intensity for every rupee of turnover, for every metric ton of crude steel produced, and also for turnover adjusted for purchasing power parity as is required by the framework. Next, we come to water footprint. All industrial operations require water. The disclosure of water footprint includes disclosure on water consumption intensity, and water discharge. Let's dive in. To understand water footprint, we need to understand three things: water withdrawal, water consumption, and water discharged. Water withdrawal is the amount of water which is brought into the entity from various sources like surface water, that is in the form of lakes or rivers, underground water, municipal water, or seawater, or any other water which is of a significant source. Water consumption is whatever water is sucked out of the ecosystem and used for the operations, for production of food, cooling of the furnaces, for housekeeping, or in the toilets, canteens, for firefighting, etc. Water discharged is the wastewater released back into the ecosystem in a treated or untreated manner. The unit of measurement here is in liters or its equivalent units. Many entities which cannot measure the exact consumption may arrive at the figure by using this formula. Water consumed is equal to the water withdrawn minus the water discharged. Both water withdrawn and water discharged is available from the inlet and outlet flow meters data. The disclosures also include intensity of consumption of water, which may be expressed in terms of per tons of crude steel produced, or per rupee of turnover, or per dollar of turnover adjusted using the purchasing power parity. Entities also need to disclose the amount of water discharged. A major chunk of the water which has been withdrawn gets utilized inside the factory or the plant or the offices. But a small portion of water is released back into the nature, which is called the water discharge. The entities are required by the Pollution Control Board norms to treat the water in the effluent treatment plants or wastewater plants before it is released into the nearby water bodies. There are three levels of wastewater treatment. The primary level removes the suspended solids and organic matter from water. In secondary level of treatment, biological processes are used to break down the dissolved organic matter. Tertiary treatment is further refined to remove the inorganic compounds using chemical processes. Here we can see Tata Steel treats water till the secondary stage before discharging it into the nearby water bodies. The third KPI is energy footprint. All industrial operations consume energy to operate. This energy can be derived from renewable or non-renewable sources. The disclosure here includes energy consumption, percentage of energy consumed from renewable resources, and energy intensity. Let's look at the disclosures for more details.
Let us take an example from an industry which is highly energy intensive, cement. This is the disclosure under this KPI for energy footprint for UltraTech Cement Limited. As we said earlier, energy can be derived by consuming electricity or consuming fuel. Renewable energy can be sources like solar, wind, hydro, nuclear, etc. Renewable fuels could be biofuels, hydrogen, etc. Non-renewable energy includes coal, LPG, diesel, natural gas, etc. Non-renewable electricity would be power generated from coal-fired thermal power plants. The addition of these two will give us the total energy which is consumed by the entity. It is measured in joules, gigajoules, terajoules, pentajoules, depending upon the energy consumed. Here we can see it has been measured in terajoules. Now, the objective here is the entity should try to continuously increase the share of their renewable energy sources as compared to the non-renewable ones. This disclosure also includes the data points on intensity as was done in the previous KPIs. The last metric about environment relates to the entity's waste management practices. Every entity generates waste in its operations. These wastes can be categorized into 7 categories. They are plastic waste, e-waste, biomedical waste, construction and demolition waste, battery waste, radioactive waste, other hazardous waste, other non-hazardous waste. Before getting into the disclosure about waste management practices, let us spend some time on these categories of wastes. The idea behind categorizing wastes into so many categories is that each of them have a distinct recycling and disposing mechanism. It may be noted here that the entity needs to disclose data about waste generated by its operations only and not by the use of products by final consumers. Recycling, sorting, melting it into form new products. Another method of plastic recycling is chemical recycling, where the plastic is heated in the absence of oxygen to break it down. Plastic waste consists of packaging materials, containers, bottles, and all other plastics which have been discarded after use and are no longer serving their original purpose. Recycling of plastic can be done by mechanical, but recycling of plastic is cumbersome, energy intensive, and expensive. Disposal of plastic is the biggest challenge faced by mankind. It can take hundreds of years to decompose in a landfill, and incineration of plastic requires a lot of energy. Next is e-waste, which is defined as the discarded electrical or electronic devices and their components, including those rejected from manufacturing and repair processes. Recycling of e-waste can be done by mechanical recycling, sorting, metal recovery from physical processes. Another method of e-waste recycling is chemical recycling, which involves chemical solvents to dissolve the metals from e-waste and then recovery of them by other processes. Disposal of e-waste is very critical since the dumping of e-waste into landfill may contaminate the groundwater and the soil. Incineration of e-waste leads to emission of toxic gases. Next comes biomedical waste. Any waste that is generated during the diagnosis, treatment, or immunization of human beings or animals, or related research activities, including the production or testing of biologicals, which may contain infectious agents or hazardous substances. Recycling of biomedical waste is needed to make it neutralized from biological hazards. Methods like autoclaving and microwave treatment are used to recycle biomedical waste. Construction and demolition waste is a waste generated from construction, remodeling, repair, or demolition of buildings or other structures. They generally include the debris, the rubble, earth, and construction materials such as concrete, bricks, wood, and metals. Construction waste can be recycled first by segregation into concrete, wood, metal, and asphalt, and then concrete can be crushed and used as an aggregate. Metals and wood can be repurposed into new construction. Asphalt can be remelted to build roads. Battery waste comprises of any used, damaged, or end-of-life batteries that are discarded as waste. It can be alkaline portable batteries used at homes, lead acid automotive batteries used in the cars and other transport vehicles, lithium ion industrial batteries used to store power in industries. Recycling of batteries is critical since they contain heavy metals and toxic chemicals like lead, mercury, cadmium, lithium. Improper disposal can also lead to soil and water contamination, harming the environment and posing health risks. Batteries need to be segregated, shredded, and separated for minerals for reuse. The best way to dispose batteries is to hand it over to authorized recyclers. Radioactive waste consists of discarded paper, plastic, clothes, equipment, machine parts having exposure to nuclear radiation in nuclear power plants or hospitals or research laboratories. They can range from low-level waste with small amounts of radiation to high-level waste like spent nuclear fuel. The recycling process of radioactive wastes includes vitrification to immobilize radioactivity in low-level waste and also includes electrochemical reprocessing for high-level radioactive waste. The disposal of this kind of waste is a complex and a highly regulated process. It is disposed in containerized storage either on ground or deep inside the ground until its radioactivity decays to safe levels. Other hazardous waste refers to any waste which by any reason of its physical, chemical, reactive, toxic or flammable nature can cause danger to the health or the environment. Other non-hazardous wastes are those which do not fall under any of these categories like food scraps, paper products, plant material, etc. So those were description of the waste categories, their recycling and their disposal methodologies. Now let's come to the disclosures under this KPI of waste management practices. Let us take a look at the disclosure of waste management practices of the FMCG giant ITC Limited. This section has the quantum of the waste generated in each of the 8 categories. The unit of measurement is in tons or kilotons. The waste intensity is in terms of turnover in rupees and again in dollars adjusted to purchasing power parity. There is a section for the quantity of waste recycled or reused by the company. There is also a section of the quantity of waste which is recycled or reused. The last section is about waste disposal through various methods like incineration, landfilling, or any other disposal method. Actually, the SEBI guidance requires the recycling and disposal details also to be given category wise. But one can imagine the amount of efforts required and the costs incurred to segregate and weigh each category of waste separately. Digressing a bit beyond the disclosure under the KPI, here is how ITC claims to have used the recycled plastic in its packaging. It has recycled 89,000 tons of paper and 170 tons of recycled plastic has been used in its packaging, which is much higher than the last year's figures. Now we come to the disclosures about social performance of the entities. The first metric in this section is employee well-being and safety measures. There are two data points: spending on well-being measures by the company as a percentage of the total turnover of the company, and the number of safety related incidents in the company during the reporting period. Let's analyze this disclosure. Spending on the well-being measures for employees and workers include premium paid for health and life insurance policies, daycare facilities, maternity and paternity benefits, among other costs. Here is a snapshot of the percentage of spending on well-being measures for employees and workers over the turnover of the companies for a few companies in the manufacturing sector. The inclusions in the spending figure may vary across the companies as it is open to interpretation. Typically, the number remains less than 1% in most cases. We can see here Asian Paints, among others, has got the highest percentage of spending on well-being measures as a percentage of revenue. With respect to safety-related incidents for employees and workers, there are three data points: lost time injury frequency rate, the number of fatalities, and the number of permanent disabilities. LTIFR, or lost time injury frequency rate, is calculated as the total number of lost time injuries into 1 million, that is, the total number of hours which are lost due to injuries for every 1 million working hours of the entity. Value chain partners also need to start maintaining the total amount of lost time due to injuries, the total number of fatalities, high consequence injuries, and permanent disabilities. Tata Steel and UltraTech Cement have more safety related incidents and fatalities compared to other companies. The next KPI in the social performance is gender diversity in business. The first data point is the percentage of wages paid to the female employees or workers due to total wages paid for the period. Wages include the basic pay, the DNS allowance, and other allowances. It also includes contribution to Provident Fund and other funds. The second data point is about the complaints received under the Posh Act 2013. That is, Prevention of Sexual Harassment of Women at Workplace, Prevention, Prohibition and Redressal Act 2013. It may be noted here that the Act, that is Posh Act, only deals with sexual harassment against women. This act covers various forms of sexual harassment, including unwelcome behavior, whether physical, verbal, or non-verbal, that is sexual in nature. It applies to all workplaces, and the Act establishes a mandatory internal complaints committee in organizations with more than 10 employees. This committee is responsible for investigating complaints and recommending appropriate action in a time-bound manner. Let us see how are the companies disclosing the details. Here we'll take a look at the BFSI sector, which employs more women compared to other industries. We have Infosys, ICICI Bank, HDFC Life from life insurance, and Bajaj Finserv. We can see here that roughly quarter of the wages are paid to women in all these BFSI entities. If you look at the Posh complaints data, the number of complaints received percentage to the female employees and the number of complaints upheld are need to be reported under the disclosure. A high number of complaints, like in the case of ICICI Bank, does not make it unsafe for women. This number depends upon the size of the organization, and it also depends upon the robustness of internal complaints committee to impartially handle the complaints. There should also be mechanisms to prevent adverse consequences to the complainant in harassment cases. The presence of these systems gives women the confidence to lodge a complaint in the first place. We can see here that the percentage of complaints to female employees is less than 1% in all the cases. Next, we come to inclusive development. How much is the entity contributing to the development of the neighborhood by providing business and employment to the local community? The data points here are purchases from MSMEs and small producers as a percentage of total purchases. MSMEs are micro enterprises having a turnover of less than 5 crore, small enterprises having a turnover of less than 50 crores, medium enterprises having a turnover of less than 250 crores. Small producers are entities which can be individuals or self-help groups or home-based workers. The next data point relates to the wages paid to the permanent or contract employees in rural, semi-urban, urban, and metropolitan areas as a percentage of the total wages of the company. Here, the amount of wages paid is an indicator of the amount of jobs created in these areas. Let's look at the disclosures. For this KPI of inclusive development, we will take a look at the giant public sector undertakings which have a great presence in the interiors of India. You may observe here that close to 50% of the procurement of goods and services of these entities are from small and medium enterprises. Entities also need to disclose their procurement from neighboring districts. Some entities have not been able to disclose this information. Some entities like Coal India have disclosed their procurement percentage from within India instead of within and neighboring districts. For disclosures regarding the employment generation, the entities need to use the guidance by RBI. Here, the places are categorized based on their populations in the 2011 census. So, any place which has got a population of less than 10,000 will be rural, less than 1 lakh would be semi-urban, less than 10 lakh would be urban, and 10 lakh and above would be metropolitan. If we see the distribution of wages for these entities, a noticeable chunk is paid in the rural and in the semi-urban areas. As a part of this disclosure, the entities also need to elaborate their policies for job creation and retention of workers in smaller towns. The last KPI for social performance is the fairness in engagement with suppliers and customers. Fairness in dealing with the customers is to be assessed by the number of cybersecurity breaches which have caused customer data leakage as a percentage of the total number of cybersecurity breaches in the entity for the period. This is a factor which would depend upon the effectiveness of the cybersecurity protection employed by the entity. Breach of customer data can lead to jeopardizing the entity's reputation and trust built over the years. The second data point is regarding fairness in engagement with the suppliers. This is measured by the credit period availed by the entity expressed in number of days. The idea is the larger this number, the more cash crunch are the suppliers facing and thus the entity is being unfair to them. Let's look at some of the disclosures for this KPI. For the BRSR reports filed in financial year 23-24, there were 19 entities with one or more cybersecurity breaches. AstraZeneca Pharma India Limited has reported that it faced 4 cybersecurity breaches during the year 23-24 and all of them were involved with customer data leakage. A 154 days of accounts payable in Brigade Enterprises Limited shows that there is a scope of improvement in dealing with the suppliers. Although this needs to be compared with its peers in the same industry of real estate and also may have some contextual information for this large number. The performance and governance can be assessed by how open the business is in its commercial operations. This means how distributed is its procurements and sales channels. The first data point for this KPI is concentration of purchases and sales with trading houses, dealers, and related parties. A high concentration by a few traders may tend to increase the dependency and proximity between the employees and the sales distributors or suppliers. This proximity can be a precursor for corruption. The second data point has the loans, advances, and investments with related parties. The Companies Act 2013 has already put in place effective mechanisms for identification of related parties and approval of transactions by the board or the audit committee or the shareholders. Under this KPI, the entity needs to disclose the percentage of certain commercial transactions with related parties. Let's see what are they. Let's take an example of large conglomerates in FMCG businesses having multiple suppliers and distributors working for them. They also have many related parties in the form of subsidiaries and joint ventures. This disclosure on openness of business has three sections. The first section is with respect to purchases from traders and their concentration. The second section relates to distributors and their concentration. And the third section relates to the related parties. One can observe that while the businesses are pretty open on their sales side, that is more than 60% is sold to the dealers and less than 10% of the sales are done by the top 10 dealers or distributors. However, the same cannot be said about the procurement side. In case of ITC, less than 1% procurement is done from traders and more than 80% of the procurement happens from the top 10 traders only. In case of Adani Wilmar, more than 20% of the procurement is from related parties. The related party disclosures are about loans and advances given to them during the reporting period and any investments made during the reported period in the related parties. So that's about the disclosures under the BRSR Core. To summarize, BRSR Core is a subset of the BRSR framework consisting of the 9 most critical ESG performance metrics. BRSR Core disclosures will involve a lot of data collection related to emissions, waste management, safety incidents, which is a way beyond financial reporting requirements. It will be interesting to see how the entities will manage to collect this extensive data from their value chain partners to meet the regulatory requirement from 25-26 financial year onwards. Thank you. Bye bye.